Hello, everyone. Welcome to our portfolio review and performance update for the CQA Investment Challenge. We are MFIN24 Investment, a dedicated team from the University of Toronto Rotman School of Management. Our focus has been on developing a comprehensive investment strategy that leverages innovative and time-tested methods to achieve outstanding results. In today's presentation, we'll cover several key areas. We'll introduce our team, we'll provide an overview of our investment philosophy and portfolio construction, and finally, we'll talk about our results of our strategies as of February 29th. My name is Bella. I'm the CEO of MFIN24 Investment. Tom leads our research, Ivy is the helm of investment, Prashant manages execution, and Elaine oversees compliance and risk. So our core objectives are clear. We aim to achieve more than 5% annualized return over a 5-year horizon and outperform peer funds in returns and Sharpe ratio. Our philosophy integrates fundamental and quantitative analysis, complemented by TA for rebalancing. We prioritize cross-validation between the 3 pillars, ensuring robust risk and compliance framework underpins our operation. At the heart of our strategy is an integrated approach, combining fundamental macro analysis with quantitative factor investing and using TA as a dynamic tool for portfolio rebalancing. This approach is adaptive, forward-looking, and evidence-based, emphasizing factor monitoring and risk management within a systematic and scalable framework. Our portfolio leverages the Russell 3000 as our stock universe, optimizing for cost efficiency and diversifying across multiple dimensions. As of February 29, our strategy has yielded compelling results. We have a Sharpe ratio of 2.68 and a return of 11.2%, placing us in the top decile comparing to our peers in both performance measurements. Next, I'll hand over to Ivy.
Thanks, Bella. In this section, I will focus on portfolio allocation. In recent years, macro factors are under the spotlight. Central banks are struggling with how to curb high inflation without triggering a recession. Geopolitical conflicts are pushing energy price even higher. As listed here, our fund considered all these macro events and their potential impact to determine the overall sector weights. One thing I would like to emphasize, besides these macro considerations, we also actively seek out opportunistic positions. For example, recognizing the AI boom, such as the emerging of ChatGPT, we have taken a long position on the IT sector to capitalize this trend. As shown in the slide, throughout the 3 investment period, we have taken proactive measures to adapt to macro shifts. Following a thorough assessment of both the headwinds and the tailwinds, we have recalibrated our target sector weights, dollar neutrality, and beta to the US 10-year Treasury yield, thereby realign our portfolio accordingly. As a result, this agile approach to macro shifts has yielded a significant Sharpe ratio. Moving forward, we are confident that employing this dynamic macro-driven mechanism, coupled with scenario analysis, factor modeling, and technical analysis, will enhance the fund's future success. Our team remains cautious in monitoring macro catalysts and navigating market trends to ensure the continued outperformance. Now, I'm passing to Tom to talk about our factor modeling.
Thanks, Ivy. Moving forward, let's explore our portfolio construction mechanism. Our strategy takes into account several critical factors, including size, value, momentum, quality, volatility, and sentiment. Each of these factors is further broken down into subcomponents, allowing us to conduct a comprehensive analysis that spans from short-term to long-term signals. By using the Russell 3000 as our stock universe and allocating strategic weights to these factors, we can capture momentum and secure gains from high-quality growth companies without overemphasizing mega-cap corporations. Next slide is about a mock-up to illustrate how these factors contribute to our sophisticated ranking system for stock selection. We will first standardize each factor for comparability, then apply specific weights to derive an overall score. Stocks at the top are considered for long positions, while those at the bottom are considered for shorting. Final stock selections will be further refined through cross-validation with our macroeconomic views and technical analysis, ensuring our decisions are robust. We also established exiting strategy to align our objective to maximize the returns while managing risk effectively. Beyond compliance, we evaluate potential gain loss, desired beta exposure, ranking shifts, and liquidity. This approach helps us avoid common pitfalls, acknowledging sometimes low volatility might not always indicate stability, but possibly infrequent trading. This comprehensive strategy showcases our analytical depth and strategic adaptability, aiming to outperform our peers. In the next slides, Prashant will give us some example of technical analysis we employed.
Thank you, Tom. Our rebalancing of our portfolio was quite simple. We collectively were reviewing our portfolio together and generating the list every week based on our model. On top of that, we were analyzing using the technical analysis on the same list. So we were ensuring that we always remain within the compliance limit with our strategic goals in place. So now let's talk about some technical analysis. So in this example at Lamb Research, it was clearly in the downtrend and then start making an inverted head and shoulder. So once it was above the trend line or the neckline, we were monitoring it closely as it was also on the top list in our model list as well. At the same time, as it came through above 200 exponential moving average, we initiated our entry, keeping our trend line breach as a stop loss. The reason this gave us a very good risk to reward ratio, and it finally paid up when we achieved our target within 3 months. Now I would like to go to the next example as a short trade from ADF. So if we look closely, ADM was not able to make higher highs, and volatility is also contracting. Along with the volatility contraction pattern, it was giving inverted cup and handle pattern. So many conditions showing weakness in stock. So we were quite comfortable that if it is hitting support line again and again, it may break the support line. And we initiated our trade near the support line as the risk was very less and the reward was quite high, and it also paid off. Now I would pass on to Elaine to discuss more about our risk characteristics.
Thanks, Prashant. Looking at the risk metrics, the total portfolio risk is 6.34%, with a historical beta of 0.21. This low beta implies that the portfolio is expected to be less volatile than the overall market. The active risk decomposition shows that the majority of the risk, 80%, is attributed to the factor active risk, with the rest 20% being idiosyncratic risk. The 1 month rolling volatility graph shows that the portfolio has relatively stable volatility patterns over the 4 month period, range between 9% to 13%. The style and industrial factors are primary risk contributors. Based on the graph, the overweights in the style factors are medium-term momentum and market sensitivity, which is aligned with the factor choice made during the portfolio construction. As previously discussed, the logic behind our sector positioning is evident in the sector active risk analysis. We have a greater allocation in sectors such as IT, industrials, consumer discretionary and energy, and less invested in sectors such as utilities, consumer staples. Meanwhile, we're closely monitoring position limits, cash weighting, and dollar neutrality to ensure compliance. Lastly, I want to share some highlights on the portfolio performance. We've realized 11.2% return over 4 month period with an annualized volatility of 11.9%. Most notably, our Sharpe ratio is 2.68, leading in risk-adjusted performance when compared to our peers. The Sortino ratio of 3.69 further confirms our ability to generate return without taking excessive downside risk. Looking at our P&L by sector, we can observe that our decisions have been well aligned with the sectoral performance. On the right, we see that in round 1, we have almost flat P&L. Our strategic shifts result in round 2 performance of 7.4%, improving our Sharpe ratio to 2.1. As we move forward, we focus on sustainable growth. Our strategies are supported by the 3 pillars mentioned earlier: the factor model, macroeconomic outlook, and the technical analysis. It's adaptive and robust. We have strong confidence in the future performance and will continue this journey of success. Thank you for your time.